Okay, cool. So today we got some feedback from some folks as well who are listening in and want to dive deep on deal structure. And I think this is a really important topic here is that really when you kind of think about doing a deal in M&A, the structure and how you pay on the deal, it really matters a lot more than actually what it is you're paying. So I want to go dive deep into kind of five key areas here and break things down. And as always, if you have questions, throw them in the chat. We'll get to those at the end of the presentation. We'll be able to go dive in much deeper here. So again, thanks for meeting us on your Tuesday and we'll kick things off. So, you typically see in a lot of transactions, people obsess so heavily on what it is they're paying, right? The multiple on EBITDA, the multiple on like whatever it may be. And they put all this pressure on the number that you're paying when really the structure of the deal matters so much more than the price you're paying. Granted, the basis in the deal matters a lot too, but the structure itself matters a huge amount for protection, it matters amount for alignment, matters the right way for if you have a deal go, dip for a period of time. So the structure itself, this deal really matters a ton. We're going to break down five key parts of what that looks like and dive deep here as well. So there are five big components when looking at the deal itself, right? So one is the debt. This can be anything from what kind of lender you're using, right? How much debt you take out in terms of leverage, what covenants they have in terms of control rights and voting rights and all these things. Second, the earnout piece. I think we hear about earnouts all the time and they can be good. They can also be really misaligned too. Third is seller carry, right? The huge money you'll ever raise. The seller carry is a massive, massive, massive tool. And what you may find is that seller carries can actually replace earnouts in a lot of structures too. Investor capital in terms of the preferred equity, waterfall, control rights, all of those things. I think this last one is actually missed really frequently. Number five is working capital and assets that come in a deal, especially if you are in a very equipment heavy space like us in paving. The assets are really crucial to nailing this piece of it. So first you have here is debt, and I'll let Chris cover some of this as well too. But oftentimes, if you're looking to go buy your first company, you typically see a scenario of saying, "Hey, you know what? Go take out an SBA loan, go lever it up, and go buy a company with below $5 million, right? In terms of total purchase price, and you're buying probably at most a 1.2, 1.3, $1.4 million company of EBITDA. And this is again the cheapest way to get started, right? It is very slow. There's that process. There's a cap on it that is, $5 million. It's a great tool to go use, but I think at times people use this tool to go lever up a company that should not have this much leverage on it as well. The local and regional banks, I think that's a great tool too. I know, Chris, we kind of want to talk through what we used here. I think Cornerstone's a great fit for this as well too. Kind of look at that piece of it.
Yeah, there's the thing with local and regional banks is they're very relationship driven and they're very industry specific. And so you have to really find, if you're going to be originating the local and regional debt, you really have to find an aligned partner who knows you and who is going to invest in you over the long term. Typically, bank leverage is really low. They want to be like 1 to 2x. They don't really like to push much more than that. The underwriting to get the deal done is usually pretty slow with a local or regional bank. But the upside of a local or regional bank is that they can be very responsive and very flexible to the needs of the business.
Yeah, and you can also go look at too. And I'd say, like Chris, you kind of look at the regional banks. They're what, 3 to 10 million typically in terms of sizing, if they go that high even.
Yeah, the institutional players really want to see like 20 million plus. The local and regional banks are kind of that 5 to 15 million. But you have to have like a lot of track record. If you're going to go for a local regional bank, like they're going to underwrite you as the operator and as the person just as much as they're going to underwrite the actual company. And a lot of times a local and regional bank will also make you personally guarantee the debt as well.
Yeah, and a lot of these local regional banks too, I think a big thing to note too is that most of them keep the money on their balance sheet. Where what you find is that some banks, maybe bigger banks, they underwrite you, they close the debt, and they go sell your debt off, right? Most of these local and regional banks will keep their debt in the balance sheet as well. So for them, the quality of business, the quality of operator are really crucial here as well. Institutional banks, right? Again, it's still slow. They want some scale. like kind of on our, we're getting to that place now where we can go look at more of these bigger players as well, right? To go have, better debt terms. Granted, it's much more of a heavy lift, right? Like we're getting audited financials on our end, right? All these things that make us, more appealing to go work with and the level of scale. Next you've got private credit, or go ahead.
I think that an important thing here is just to show you kind of how things kind of scale up. Like an SBA loan, you're maybe going to be 2,500 to 8,000 out of pocket in order to in lender fees to originate it, lender deposits, and that. A local regional bank is going to be probably that 10 to 20,000 mark, whereas like an institutional bank, they could be 100, 150,000 because of all the third party reports they require. Sometimes they require you getting a full quality of earnings to have an independent third party come in and do that if you don't have audited financials. So, as you kind of go up the scale here, a lot of people want to jump straight to institution, but you really have to have that level of scale to make it make sense, because there are a lot of, lender fees and other things that you have to pay for upfront while the loan is getting underwritten.
Yeah, and then you can look at private credit too, right? We've used private credit in the past before as well. That was great for where as a business, right? Because it's, quick, right? There's a level of speed to it, which is really important for us at the time too. And there's also pretty flexible depending on the deal itself, right? If they look at this long-term relationship. So private credit can be great if you're in a rush. Then you also have mezzanine, right? In terms of kind of sitting between potentially your senior and your pref equity investor capital as well, right? So this gives you a bigger stretch, but also note too is that it's not cheap, right? They're being paid for taking that usually second position risk where they're leveraging this company up more effectively overall as relates to kind of total capital stack relative to EBITDA net free cash flow. It's a really important thing to note here too is that mezzanine can be great, but it also does put more risk in the deal as well and more weight to it. And sizing. I know we talk this a lot on these episodes here too, is that when you look at sizing debt, this is really important, right? Like you shouldn't always take the maximum amount of debt that a bank or a lender or whoever it is will give you, because the business itself can be really stretched, right? So the likely scenarios that you go acquire a company is that you're going to have some level of a dip in the first period of time between revenue going down potentially, maybe it's seasonality, right? Maybe you just had employee turnover, whatever it may be, is the likely scenarios you will see some level of a dip. And you have to go think about, can this business survive it, which we'll cover here in working capital later, but can this business survive, right, the payments on this deal? Also looking too of like, does the actual term of the loan match the thesis of the fund, the holdco, the deal itself, right? And making sure those align are really crucial, because we don't want to have happen is that making sure your, balloon payments coming up and you have no way of providing liquidity for it, right? Or refinancing it. So making sure your debt aligns really well to what it is you're buying is really crucial. I'd say lastly, the credit agreement is so crucial in terms of the rights that the lender has and rights that you have as the business operator between personal guarantees, covenants, right, lockups, prepays, warrants attached to it. So there's all these different areas that a group can kind of tie themselves in. Chris, we don't share a few examples here too in terms of like what you've seen in credit agreements that may be beneficial or fair and things that you may look to avoid in the future as well.
Yeah, I mean the credit agreement is really the legal document that is going to govern the terms of the loan, as Sam said. And one of the things that I always look for in the credit agreements are what are the actual reporting requirements. We've had credit agreements where the reporting requirements are biweekly to monthly, and when you're doing that, when you get into that, you're like, this should be fine. But then operationally, now all of a sudden we're having to do all this extra work every 2 weeks or every month to get all of the covenant compliance stuff in to send to the bank, and it can kind of be a little bit of a time killer. Whereas other times we've negotiated into the credit agreement and say, hey, we'll do it every 90 days and we'll just do it at the end of each quarter, and that's a lot more manageable. The lender will determine. In some credit agreements, the lender can determine if you can buy other companies. They can determine when you distribute your capital. They can determine the salaries of key employees. They can determine, if you, sometimes they can even determine if you sell additional equity in the company, or not. There's a lot that credit agreement governs, and typically a credit agreement that we've seen is between like probably 70 and 120 pages of just really everything is thought through of what you can and can't do. And it's really important to understand your rights and obligations underneath that credit agreement, because that's where, the rubber really meets the road in terms of risk and compliance.
I think that's the big thing too, right? You'll see really frequently is that, okay, you need to go do an earnout when you're buying a company from someone, the seller themselves are really aligned in this transition. And I think that may be true for if you're buying a personal company that is a smaller business, right? Looking to buy something that say, sub $2 million EBITDA, this can make a lot of sense because the likely scenario is that that owner has been the head salesperson, head account manager, right? Head of operations in that company for a very long period of time. And a lot of things are institutionally tied up with them. But if you're buying a bigger company, right, you likely don't need this if the management team themselves is established enough here, which is just a lot more, may not have the right incentives overall. So I think those things are really important to go note is that the earnouts themselves can be really great if they're small in terms of the company sizing. But overall, like we've actually leaned away from a lot of these in transactions we're doing today and going forward. And have in turn actually shifted a lot of this to a seller carry instead.
Yeah, and I think the most important thing on an earnout is that earnouts have to be incredibly well thought out. You can get earnouts in bigger deals, you can get them in small deals and all that stuff. But at the end of the day, an earnout is just a tool. And there's a lot of if-then statements in an earnout. So like a quick example of this is you say, well, EBITDA is going to, you have to maintain the same level of EBITDA that you have done historically, right? Well, there's a lot of things that can go into to influence what EBITDA is. And there's a lot of things that, different ways that you can actually inflate EBITDA or even, kind of depress EBITDA a little bit. There's a little bit of movement there. And so a lot of times what happens is, it seems really simple on the surface where you're like, yeah, just, do the same EBITDA that you did last year and it's good. But there's so many factors that go into EBITDA that, and they're not in control of the company anymore. You are. And so if you make changes that affects EBITDA that, maybe you need to make some investments into the company that are going to have a short-term negative impact in order to have long-term growth. Like think about it like trimming down a rose bush, right? So you got to kind of trim it down before you can really prepare it to grow. And so then you have this earnout where the seller is being incentivized off EBITDA, but these changes to the business need to happen that could potentially depress EBITDA. And so then it just creates this thing with the seller where the seller is feeling like the deal has changed on them, and it creates a lot of contention. And so every single earnout is just one massive like if-then statement. If EBITDA is this, then this. If it's this, then this. And there's a lot of ambiguity in it, and you get into different kind of structures that can make it difficult to think of all of the possible scenarios. And not saying that it can't be done, it absolutely can be done. My experience in the industry that we're in terms of blue collar, they don't know. A lot of them don't know even what EBITDA is. When we go and talk to these business owners, a lot of them don't know what EBITDA is. A lot of them don't know, like the earnout part of the structure kind of goes over their head a little bit. And so what we see is that creates a massive misalignment because they don't really understand exactly what the earnout is. And so that's why we have pushed more towards a seller carry and kind of effectively achieving the same thing that an earnout is just through a seller carry, because it seems that the people in our industry that's more effective. But I would say it's very industry dependent, and you really have to look at like what the sellers in your industry are willing to do, because you can go through and organize and structure an entire deal, and then at the end of it, you put in that earnout component, and the seller's like, no, I'm not gonna have you tie up 30% of my money for me to hit metrics when I won't control the company anymore. It's probably the biggest objection that we hear.
Yeah, and the seller carry too, it does, a few things here as well, right? Like it's typically less than most of their debt in terms of costs, right? They're usually a decent time period on it. And also, kind of act like an earnout when looking at, collateral, right? Say there's an issue that arises, right? That seller carry can be in jeopardy for the seller if they, misrepresented something, right? That basically can act as our escrow account for a period of time too, right? If there's ever any issues there as well. But it's, really strong kind of looking at the structure around it. And there's also a lot of benefit too for the seller, right? If you're selling a company you've owned for your whole life and you've got a big capital gains event coming, you can spread that gain over a handful of years. You can have a level of recurring cash flow for yourself into retirement, right? You can get typically a higher price as well. Like we may be willing to pay a little bit more if we can go carry more of it from the seller, right, and go structure it a certain way. There's also still a little skin in the game that kind of operates as an earnout in a certain way. There's certain maybe metrics tied to it. Maybe there is escrow tied to it, right? So there's things that allow us to go really help there as well. And also, for us, it's super helpful because it's, banks can look at it potentially as equity in the scenario as well. It, locks in that transition for a period of time, but also allows us to bring potentially less cash to the table and then, higher leverage, but in a much more safe way. And, here, I think this is a great piece to look at too, is you're going to think of how the waterfall flows, right? You've got your senior debt, your seller notes, your preferred equity, and your kind of common equity or sponsor equity as well that sits behind it. On our end, this is what a lot of our structures look like typically, is that you're seeing the senior debt, the kind of equity stack behind it as well. We raise a lot of our capital in preferred equity as well too. Yeah, I mean, this is a really common type structure. And obviously each one of these areas has a lot of variability to it. But in this structure, it's really crucial for us is that this is typically the waterfall that we'll see. And on, our end, right, how we raise capital on our end, right? We pay that kind of fixed 8% target return. That's paid monthly, sorry, not quarterly on it. We have a liquidation preference every 2 years, right? So between 1.5, 1.8x in terms of liquidation at the 2-year mark. We also have an option to go kind of roll that liquidation preference into a subsequent 3-year hold period as well, with a similar type structure, kind of built into it as well for tax efficiency. And this is really important, right? So we're kind of looking at the preferred equity, right? They really focus on the liquidation preference, right? They're not really operational in the piece of this as well too. So that's super helpful for us. We're kind of looking at the controls we have here too. Chris, if you want to cover the kind of working capital assets piece of it, I feel like this piece is so overlooked when looking at buying a company. And, I've done a few posts this recently, but the working capital component here is so, so, so crucial. One, for survival, and two, because growth is freaking expensive. You kind of want to go into like what that looks like in a typical deal and what you look for there.
Yeah. So working capital is I think a good way to think about it is it's like the grease that makes the engine go. It's the capital in the business that's tied up in order to operate the business. And so when you look at a business, and there typically how you would structure the working capital in the deal is you would have a target working capital based on historical financials, based on your quality of earnings, and then you would have a true up period 30 to 45 days post closing, saying, hey, our target working capital for this business is $1 million. And in 45 days, we're going to true that up where if the working capital comes in under $1 million, the seller is putting, more money in. If the working capital comes in over $1 million, then you're remitting to the seller, the excess. And so working capital is one of those things that, particularly in our industry, it's a really tricky thing to calculate. And I can get into a lot of the reasons why that is, but one of the things that you really have to make sure of is the accounts receivable and the accounts payable that they're truly earned. Is a lot of times when you're underwriting these companies, they'll put, accounts receivable on the balance sheet but they're not fully earned yet. And so when you're looking at it and you're underwriting it and you're like, oh, this is great. Here's kind of what the working capital is, but it's not, it's like you have to go in and verify the AR and the AP in order to really kind of hone in on what that is. But working capital is the probably the most, I would say the most crucial, one of the most crucial parts of the deal. And the reason for that is if you come in with here's like, if a business is losing money, the first place to look is the decrease in working capital, right? because that's where it's going to hit you first. Is your working capital is going to start to diminish before you even really see anything else. And so the working capital is that lever that if you can nail it and you can get it right, then you can make sure that the business can continue to operate and run. If you underestimate working capital, then you effectively have raised the purchase price of the company because you're going to have to put in a bunch more equity to replace the working capital or debt. So, either way, my general thing is that I always am way conservative on working capital. I would prefer to pay, um, a little bit more to have more favorable working capital terms, as long as it's net positive for us. But the working capital, when I'm structuring a deal, I spend an enormous amount of time on the working capital requirements of that deal. And then also the modeling aspect of this and being able to project this out in the future is like, what is the working capital, in relationship to the revenue, right? How much working capital do we need to support X amount of revenue? Because a lot of times when you're going and you're saying, well, I'm going to double the size of the company and then I'm also going to decrease expenses. It's like, well, you're not going to do that for free because growth requires capital. And so do you have sufficient working capital in order to grow the company? And it's worth taking, the couple extra days to really be familiar and comfortable with this, to make sure you're not going to run into a world of hurt later. And the reason I'll tell you where people get into trouble on this is they come in, the working capital number is off. They have the true up period. The seller is not willing to work on the true up period. So you're kind of in this thing, the business performance, the business dips slightly in terms of performance. And now you can't go out and get debt to help with the working capital because the bank is going to look at how the working capital has flowed. And if they see it going down, it's a lot harder to originate a working capital line of credit. So when you're going in, make sure you're well capitalized, make sure you have the working capital line of credit, make sure you have everything handled beforehand, because if you get in there and you're undercapitalized, your options are pretty much limited to equity.
Yeah, it's also a big thing too when you can look at the equipment, right? In the space that we're in, the equipment is always, very expensive, very heavy equipment too. So really understanding what it is that you're buying and making sure you're not going to acquire a company that has painted equipment on the job site that looks better than it is, because that can be a massive, massive, massive expense. And also the equipment too, like we really focus on turning our equipment out every few years for newer equipment, so that we found that it's just a far better overall cost, because if equipment goes down, you've got the one expense to go fix it. But the bigger thing you have here is the operational downtime, right? If you lose a week of working because your materials and equipment are out, that is very, very, very expensive to go do.
100%. 100%. And I'll tell you kind of a funny anecdotal story that we were down at our company in Texas, and the previous owner of that company, we were eating lunch, and he told me a story of a company maybe 20 or 30 years ago that they were bought by a big private equity firm. And what the owner did is he took all of the junk equipment on the yard that wasn't even running. He painted it up real nice, and then he went and transported it and put it on all the job sites so that it made it look like all the equipment was operating and running. And so then when they closed the deal, he got a better multiple and more money, and the equipment wasn't really operational. And so that's the kind of stuff that you have to look out for, because there's this kind of saying, and it's kind of a negative connotation. You hear it in real estate a lot, but it's like buyers are liars and sellers are worse. And you really, a lot of sellers are really great people, but really go into it of like, is this person lying to me? If they were lying to me, how can I verify if it's true or not? And really taking the time to like go in kind of line by line and make sure that what they're telling you is the truth. Because after you own the company, your recourse against the seller is suing them, and that takes a lot of money. So you've got to you just got to make sure that you'll save a lot of time, money, cost, energy, sleepless nights, emotional trauma by just taking that little bit of extra time to verify everything.
Cool. And then here too, just want to share kind of two examples of the capital stack on our end and what that looks like. So This was our acquisition in Texas, Cornerstone. We got about 5.5 million of senior debt, right, from more like a localized bank. We brought about $3 million of equity to the table, and we had a $1 million seller carry, mostly kind of collateralized by equipment. So, really simple structure. We ended up being what, 33% in total equity needed to go close. So we felt confident in that structure because the multiple we were paying. So it's really important to look at the company itself in terms of predictability. So this company focuses on reoccurring maintenance type work on highways, right? The DOT work for the bulk of their business. And on our end, we knew that, hey, this is very recurring. We're comfortable now taking on higher leverage between the seller carry and between the bank debt because of one, the price point we paid for it, but two, the type of work that we knew would be recurring going forward, so we can go project it much more so versus taking on a big risk to go do it.
And I'd say the other thing that kind of more of the qualitative side of this is this in determining leverage that I think a lot of people talk about, but this particular deal, we were under contract on it for about a year. And so I had the opportunity to really get to know these sellers because I was literally talking to them every single day for a year. So by the time we got the deal worked out and we were figuring out, okay, like what kind of leverage do we want to put it on it and this and that, it was like I had a very good understanding of who the sellers were, and it really helped. It really helped us make the decision of like, okay, we have a little bit more trust in the sellers here, so we're going to push the leverage a little bit more because we feel like we've been able to vet that relationship a lot deeper than what we normally would, just given the amount of time we were under contract. And so far since acquiring the companies, that was 100% the right decision. The sellers have been huge assets to us. They are all very, very engaged in the business, and have been really amazing to work with. And so it really is on a case by case basis. And you have to look at the risk on the deal is like, you have to look at it like almost holistically and then be able to understand, okay, I'm willing to push the leverage a little bit higher than I normally would for these reasons, and then document it and have it written down and solidified. So there's accountability to it. But yeah, that's how, that was another reason why we pushed the leverage on this one a little bit.
Cool. And this is a company we're actually working right now in terms of acquisition, right? So kind of looking at the, structure here, right? We about $12-13 million purchase price here, and what we're seeing is that on the pricing side, we think we'll come in terms of debt. That debt's actually pretty high for what it is. We'll find more localized bank debt to go support it. There's two seller notes, right? There's actually two sellers, I believe, here too, and looking at the structure around it in terms of timing. And then, the big piece of it's going to be preferred equity, right? And, part of why we are okay in terms of taking on higher leverage here is that we're getting to a place now where certain companies we acquire have meaningful synergy between each other. So, for example, this company, we feel as though we can go add essentially $2 million pretty quickly to it because of synergy we have in the company action in our previous slide in terms of the concrete work too. So that piece of it as well allows us to feel more comfortable in saying, okay, we're okay taking on higher leverage because of the structure of this deal, because of the type of company it is, and because of kind of how it's paired along with our other companies as well. Cool. And again, thanks everyone for, hopping on here, right, to go dive deep into deal structuring. We'll open up for questions, but again, we're here every Tuesday at 1 p.m. Eastern. These are all recorded, put onto YouTube as well, but we'll open up here for questions on deal structuring and all things like that. I see a few right now I will hop into. So one, buying a company with expensive capital equipment without testing it all during due diligence is crazy. I mean, honestly, that happens pretty frequently, right? Like there have been transactions that happen that way where they paint the equipment, they put them on the job sites so they look active, and in turn, people don't go test that, right? They take this face value. So, if you don't know to look for that,
like, can you even test all of the equipment, right? Like some of these companies that will have 300 pieces of equipment that are spread across 3 states. And so if you're going to fly somebody out there to look at the equipment, that's one thing, but to actually run the equipment and do a diagnostic on it and to do it, I mean, you're talking like probably hundreds of thousands of dollars. And so there, you kind of have to like draw that line on the risk of like, what are we willing to do and how can we get to a point where we're mitigating our risk, but we're not incurring, $500,000 to go and verify all the equipment across all the different states and have it take 6 weeks.
Yeah. Next question here. What are KPI benchmarks that you would look at in these roll-ups, right? How big a roll-up should be at, the net debt, EBITDA, and DSCR, sponsor ownership at the end state, how to start, and what are expected dilutions, returns to investors. So we'll kind of go piece by piece here. So how big a roll-up should be? I'd say it depends on the industry that you're in, right? What you may find is there are breakpoints in certain industries based on how big you are in terms of scale. So what we've seen is that, call it 10 million, about 50 million, probably 100 plus. There are different breakpoints that are getting valued at based on the scale you have. Also, the integration piece is really crucial here as well. That we like playing on the acquisition side below what the big PE shops would go acquire. So we're still getting good pricing, but enough scale there is as well too. So on our end, like we want to get meaningful scale because otherwise you're leaving dollars on the table as it relates to the maximum expansion possible for multiples that you're seeing. Net debt versus debt EBITDA and DSCR. Could you share more of what you mean by that? We'll kind of skip to the next question, but kind of drop it in the chat as well too, and we'll get back to that one. So sponsorship, ownership at the end state, how to start, and dilution. In our end, like we're focusing on raising a lot of our capital as preferred equity with structured buyouts. The reason is that we want to own this company long term ourselves. So we're structuring a way in which we have the ability to go pay investors a very good return and have the ability to go keep ownership and kind of voting rights ourselves in house. So it depends on what your goal is and kind of how you can go raise your money to structure that as well too. So what I'd say is it really depends on what you can go accomplish, but also the structure that you want to have and what your investors want too. So certain investors will love the structure we have, certain investors won't touch it. So it depends on who it is that you have and kind of aligning a structure to them, but also make sure that structure works for yourself as well too. The last piece of this question too is returns to investors. On our end, right, we've structured all that as preferred equity. So right now we're kind of going to do step down tranches. So right now we're offering 8% current pay and between a 1.5x and 1.8x buyout or roll in 2 years. So depending on your check size, you get better economics. That's how we're looking at it today on our end. Okay, this is a good one. How are you able to negotiate 0% seller interest on a seller note for a concrete acquisition?
That's a great question. It was a purchase price dispute. So they wanted, I think it was like 14 million. We wanted to pay 13 million. And we were going back and forth on it. And, so I said, well, how about you give us a 0% interest seller carry for $1 million and, put the balloon out in like 3 to 5 years. And we're willing to go up to a purchase price of, I believe it's 14 or is either 13 or 12 or 13, 14, one of the two. But so that was a concession that we made to get the deal done. We really liked the company. We really liked the operators. I really didn't want to pay any more for the deal. And so we felt like a 0% interest, seller B note on the seller carry was a good balance of being able to get the deal done without paying too much for it.
And back to the previous question too, leverage metrics. So net debt divided by EBITDA multiple turns, and DSCR entry, and then running the platform. What are levels that you feel comfortable with?
It really depends on the company. And I know that it really is dependent on the company. And what I like to do is look through it to where it's like a really practical thing. It's like, look at how much cash is in the bank account at the end of each month. Do that for 24 months and then see if you can service your debt, right? And see how comfortable you feel servicing your debt on that. And it really is just looking at how the cash is moving through the business, determining how much leverage you want to push on. I mean, I could tell you all of the canned responses, but the truth is that it really is dependent on the individual things in the company. And a way that I would determine what I'm comfortable doing would be to understand exactly how cash moves through the business by breaking down the last 24 months of cash flow and then saying, hey, if my debt payment is X, am I going to be able to comfortably service this debt?
If a company has limited existing working capital at acquisition, the right amount is worked into the deal using the purchase price financing. I mean, it really depends, right? Like the banks can underwrite this deal based on the overall value of it. I think you have a lot more leverage with the seller if there's not a lot of working capital in it. I'd also be very wary too, is that likely is going to have to come from your equity, right, to go fund the business itself too. So the bank may underwrite it saying, this is now instead of a $1 million loan, you need 1.3 million to go fill up the working capital to be sufficient. So those are things I go think about in that transaction as well too, is where's that going to come from, right? It'll either come from debt or more equity you have to go bring to the table too.
I would that would make me very nervous. If there's a seller who I can see that they have limited working capital, it means that the business has not been managed appropriately, or there's something else going on in that business that where they're not, their pricing is wrong or something. But if a business doesn't have, especially if the business is like 10 plus years old, if it doesn't have like enough working capital, there is a deeper problem going on, and you should dig until you find that.
Where do you guys see the best source of effort to finding great businesses? Are most of these brokered or something you guys could direct to seller? So I think one thing we found that's been super helpful is that, if you're going to look at buying a company from someone and they fit that typical profile of the owners in this industry, the likely scenario is that their friends are people in similar positions themselves. So that's a great place if you've already acquired companies to go work with your sellers, be good relationships there to see who they know in the space too. I'd say if you start performing on deals too, in terms of being, I think the biggest thing is like do what it is you say you're going to go do. And in turn, brokers will want to work with you in terms of off market deals, on market deals, right? Getting preference treatment there as well too.
Yeah, it's really like a lot of brokers can, come with some great deals. But you got to be able to build the relationship. The broker has to want to work with you. Um, you know, you can get investment banks have some great deals. You can find great deals off market. I will say if you find a deal that's off market, it'll take longer to close because they don't have any of their financials prepared, generally. So when you go to a seller where, you know, they're completely off market and it was a warm introduction from somebody in the industry and they're like, hey, I'm ready to take some chips off the table or sell, you're going to spend probably 2 or 3 months, maybe even up to 4 months, just tracking down all of the things the broker, the investment bank would track down for you. So there's a trade-off there for sure.
Regarding seller notes, I'm working a deal with two seller notes, one full standby for 10 years and one on standby for 3 years, then amortization over 4 years, 4 to 10. Does interest accrue and added to the principal balance during the standby period? Is it typical for the full standby note to accrue interest during the standby period? So let's start with that one first. I would think it does, right? If
Yeah.
there's interest rate tied to it, is that it's accruing and going on the back end of it?
Yeah, it's dependent in the note itself. You can have a note on standby that doesn't accrue interest, but it'd be explicitly negotiated, and that'd be a pretty rough deal for the seller. So he's essentially giving you a 0% interest loan for 10 years.
Yeah. Working capital, do you guys usually negotiate working capital and add it to the purchase price? So it's part of, let's say, the SBA loan, but the seller leaves the negotiated amount of working capital. So we don't use SBA loans at all internally.
I don't like underwriting debt to working capital. Like the seller should leave, and if the seller's not willing to leave that, then I'm not going to do the deal. Like that's just one of the lines for me. It's like I'm not going to come into this business and then dump a bunch of money in it to make sure the business has enough money to operate. That's why I'm buying the business. And so, for me, that's just a hard, like if I get in with a seller and they're like, really pushing back on the working capital stuff, it's like, well, you can go sell your company to somebody else. Cause, I'm not like my expectation is that if I'm paying you for the business, you're going to leave enough working capital in the business that we can continue to operate.
Yeah, I agree. Cool. Any other questions that you all have on this topic? I'll give everyone a second here. Also, too, if there are topics that you want covered and you're listening to this too, feel free to send us a DM, reach out to us, and we're happy to cover certain topics here as well. And I was looking for ideas to talk through. And what kind of lenders do you use? What minimum size of debt will they start looking at? On our end, we've used most things across the board besides the institutional route. I think we're getting to that place now where we can go have a bigger amount of senior debt across the entire platform itself, where we can qualify for, the best quality debt, even if it takes the most lift to go bring in from the work required, from the capital required to go bring it in, and from the sizing as well. So I'd say we're getting there now, but we have used, a credit fund to buy our first deal. We've used mezz debt in the past. We use preferred equity for investors. We've used kind of local banks as well too. So what I'd say is that, our goal going forward is to go find a bigger bank we can go work with to allow, a much easier transaction and bigger amounts going forward too. And then how do you know a good amount for working capital? I mean, again, that's dependent on the business, right? Like I would go look and see what they actually need to operate and understand where it's been the last while too. And making sure you don't have to go feed it is usually a helpful thing too. So I'd say like really looking at historicals, but each company will be really different depending on the type of business that it is.
Yeah. So working capital is calculated by current assets minus current liabilities.
Cool. Any other final questions on here as well? We got some good ones today. Cool. Well, everyone, thanks for hopping on your Tuesday. Feel free to forward this to someone as well who'd find some value in it too. We always like having new folks in here as well. And thanks again for making some time, and we'll see y'all next week.